Hey, what's up, guys? It's Ezekiel Chu here. So, today I'm going to break down one of the most effective trading methods out there, swing trading. So, swing trading, when done right, allows you to ride the market movements and lock in profits without you sitting in front of your charts like all day long. So, stick with me on this one, and I'm going to show you how to master swing trading by just using these three methods that I'm about to show you. All right, so before diving in, let's first go through what swing trading is. So, in simple terms, swing trading is a strategy for capturing short to medium term price movements, right? Which is often called swings in the market itself. So, these swings represent significant price movements, either upwards or downwards, and they kind of typically occur over a few days to a few weeks, right? Which is what we call swing trading, right? During this period in time. So it's kind of like different from scalping, whereby you're trading the shorter time frame. So swing trading are trades that kind of last, right, for a few days to a few weeks, depending on your trading preference and your trading time frames. Okay, so swing trading aims to take advantage of all these kind of price movement when whether within a trend or during market correction. So in an uptrend, right, swing traders, okay, capitalize on this kind of bullish price swings when the price rises, right? And then in a downtrend, they aim to capture a bearish price swings when the price goes down, right? So swing traders, what they do is they identify opportunities during, they also do that, right? They also do that during market corrections, right? So when temporary price reversal occurs within an overall trend, right? So this is also another way to trade swing trading itself, right? Not just within a range bound setup. Okay, right? Got it? So now, in this scenario, right, traders trade within a range, right? That is fluctuating between a defined support at the bottom and the resistance at the top. So let's say if you are a swing trader, you are going to buy in the area of what? Support area, right? That's where you're going to buy for price to go up, right? So then the key question is, if you're going to buy at a support area, where should you exit your trade as a swing trader? So the general rule of thumb is that swing traders can look to exit their position, right, when the market goes up, right? You buy at the baseline, at the support area. When the market goes up, they look to exit their positions before the opposing, means the other pressure. So you are buying right before the selling pressure, right? The opposing pressure comes in. So where is this opposing pressure, right? So the opposing pressure is traders who are what? Who are looking to sell, right? So where will traders be looking to sell, right? So traders will likely look to sell where? At the resistance level or at swing highs, right? So exiting your trade before the market hits the resistance from the other side, right? It's extremely important. So for a long position, right, sellers typically emerge, right? All of a sudden they appear where? At resistance level, right? Because that's where a lot of selling will comes in, right? Or at swing highs, right? Or the previous highs, right? So this is where the price has struggled to rise in the past. So these areas are where sellers will likely enter the market to short the market, right? And then also a lot of buyers will want to get up at there. So that area becomes a highly pressured area, right? So therefore, as a swing trader, right, you're going to want to exit your long trade, your buy trade before price reaches the resistance level. So that's where you can capture the upward price swing. while avoiding the selling pressure at the top that can potentially drive the price downwards. So yes, on the other hand, so if you're going to short the market, right, you're going to short the market where? Near the resistance level, right? That's where you want to exit the trade before price hits the support level, before, right? So which is where buyers will likely step in and they want to buy at the area, right, and push the price out, and then sellers will want to get out at that area. So this is a highly pressured area now on the bottom side. Got it? Right, so the goal of swing trading is to take advantage of all these kind of price swings within a defined range, right? And then you want to exit before all this opposing pressure comes in, right? So that's where you can get the most out of this range bound price movement while minimizing the risk when you get out at the right spot, right? So this is in essence the core concept behind swing trading, where you identify key support and resistance areas, you time your entries near these levels, right? And then you exit them before the market reverses due to opposing forces, right? So this strategy allows you to take advantage of short to medium price movements, right? Without kind of overstaying in this kind of positions when the market kind of changes the direction, when odds shifts, right? So now we have covered this main principle, right? The main principle, right, of swing trading. So that's where we're going to move on to cover the 3 methods of how you can trade this whole swing trading. The first swing trading strategy is what I call box trading. This is designed, right, for markets that are in a what? Consolidation, right? Where the price moves sideways, right, in between clear support and resistance level, right? So in this phase, right, the market bounces back and forth, up and down within this kind of range, right? Creating this kind of box. So what I like to do is that when you start seeing market doing this kind of box, what I'll do is that I'll draw a rectangular box on the chart itself. All right, so this is where you can identify the range, right? The levels. Okay, so what does it mean when price is in this box, right? This is kind of where it means that neither the buyers or sellers are in control at this moment. It's kind of like the market is like indecisive. It's like it's gathering momentum, but you cannot really decide yet until the buyer or the seller, they take control. But right now, neither of them are in control. Okay, so this strategy, the box trading strategy, allows you to capitalize when price oscillates, right, within the box. Okay, so that's where you can do that, and then you can also wait for potential breakout opportunities in either side as well. Okay, so now this market creates an ideal scenario for range bound trading, right? Trading in the range. So this is where you can capitalize on what? All these repeated bounces, up and down, between the support and resistance level. So that's where what? You can enter long positions at where? The support level, where you expect price to go up, and then short positions at the resistance level, right? Somewhere there, right? Where you anticipate price to go down. So because there is an absence, right? The absence of a strong trend, this is where it's easy to identify this kind of key areas and key entry and exit points within the range itself. All right, so range bound trading strategies, they kind of exploit this kind of oscillations, right? So therefore, traders can aim to take advantage of this kind of price movements because they have repetitive nature. So once you see that price heads up, heads down, then there's a chance that it's going to head up again, and there's a chance it's going to head down again. So now the goal is to what? Is to buy at the support level and sell at the resistance level, or opposite, right? Go short, sell at the resistance level, and then what? cover it, right, at the support level, right? That's where you can capture profits within the range. Okay, so now remember, you got to what? Stay alert for what? Potential breakouts. Remember, I look at there's a period in time before eventually going to break out, right? Because price cannot last there for sometimes it ranges before it goes, sometimes it can ranges a long time. So that's why you got to see the previous history. Okay, so but eventually it's going to break out. All right, it's going to break out. So that's where you got to be alert for that. And that's where a new trend can start. It could be either a trend continuation from the previous trend, or it could be a trend reversal from the previous trend itself. Okay, so now the core concept in this scenario is that the market trades within a range, right? It fluctuates between the support, right, and the resistance level. Yeah. So now, as a range trader, you buy within the range, you exit in that range itself before. All right, get it? So that's where you can play in the range until it breaks out based on the previous history. Got it? So in this example, you can see how price repeatedly tests the support level but cannot break below it. Right? So the rejection of all these lower prices indicates what? That the buyers are what? They are actively defending. They are defending the support level. So which creates what? An opportunity what? For potential buying. So when the price consistently like kind of holds above the support level, right? The market could be what? Gearing for a bounce back towards the resistance level, right? This allows you to set the stage for a potential and possible long trade upwards. All right, so the market can confirm the buying pressure, right, by waiting for price to react at the key support levels. Okay, so this approach, right, helps you to enter at a more favorable pricing, right, increasing your chances of a more profitable trade, a higher probability, right, as price move towards the higher level, right? So therefore, you got to be patient, you got to observe all these critical levels, and then you include price action into it. Candlestick patterns, price action into it at all these crucial levels as an extra confirmation to enter at all these levels. All right, so now on the other hand, let's see here. The market consistently traded lower, right, at one point, right, indicating a sustained what? Selling pressure. As in this case now, the sellers dominated the price action. So price continued to decline, right, reflecting the strength of the downtrend. So at certain point, the buyers took control, reversing the market direction. So this strong buying pushed the price higher, right, closing near the highs, and then signaling a shift in momentum from bearish to bullish, right? So this suggests what? A start of a new trend, right? A new upward trend. So this price action often signals a reversal or a pause in the downtrend, as this strong buying pressure overtakes, right, the previous selling pressure. So that's where you can use this shift of momentum to take advantage of this kind of upwards price movement. All right, so this setup represents a swing trading opportunity where you can consider going long. All right, so now when you observe price rejection at the lows of the support level, it signals that the buyers are stepping in and defending that area. So which could lead to what? An upward price movement. Right? So that's where you can enter a long position on the next candle, right? That confirms the rejection of the lower prices, right? Indicating a potential bounce from the support itself. To manage your risk, right? Place your stop loss at a reasonable distance below the lows of the support level, because that's where you got a baseline, right? So this stop loss will be your what? Your safety net to protect your position, right? If the market breaks below the support, and that's where it invalidates the setup. So therefore, placing a stop loss below the support level will give you room, right, to minimize potential losses if the market goes against you. All right, got it? So this approach will allow you to capitalize on this kind of short-term price swings within this range. So when setting a stop loss in a swing trader, avoid placing your stop loss directly at the support level, right? As price, they often dip briefly below it before reversing back upwards. So therefore, to prevent being stopped out by all this kind of forced breakout, right, give your stop loss some buffer, right? Some buffer to account from all these short-term fluctuations at the area itself. All right, so now, as a swing trader, your primary objective is to capture one swing within the market itself, right? So from one end to the other end, right? So therefore, the critical questions that you must answer is, where is the opposing pressure likely to appear? So in most cases, generally, the opposing pressure will emerge at the next resistance area, right? That's where the sellers will likely step in and push the price lower. So to identify this, you can look on the left of a chart to spot the resistance zone where price have previously struggled to move higher at that area itself. Right, this is where you should consider taking your profit. So as this is the most likely location for the market to face selling pressure, right? So therefore, by exiting your trade before price reaches before the resistance level, you lock in the gains, and then to avoid the risk of price reversing back downwards itself. Okay, so you can see in the example that the market didn't reach far enough before it reverses back in towards the area of support. Right now, however, on the second attempt, the market successfully reached the resistance, right? That allows you for potential profit-taking opportunity. All right, so depending on how you manage your trade, it could end up being a break-even trade, a small winner, or even a losing trade. So I mean, this is not where I'm going to talk about like trade management here, which is in my other videos, right? This is where I want to talk about the concept of swing trading. All right, got it? So now that is what we call box trading. Okay, so now method 2, following my friend, right? So this is what I call following my friend. So this approach is in a way effective when the market is in an uptrend, right? In an uptrend, the goal is to what? Is to time your entry to capture one swing in the direction of the overall trend, right? So when you align your trades with the main trend, the dominant bullish movement, right? This is where you increase your chances of success, right? Because you trade with the market natural flow, right? So now, the key aspect of a swing trading in an uptrend is that you recognize that there are typically multiple swings as price moves higher. All right, it's not like just one straight line, right? Usually there are multiple swings. All right, so you can see that price aligned with the trend that are usually stronger. So you want to trade with the trend, right? So this swing would result from what? They result from buying and selling pressure as a natural flow, right? So that's where you want to, as a swing trader, you capture all these swings that is in line with the prevailing trend. You want to enter where? During the pullbacks or the consolidation and ride the next movement upwards. So trading in the direction of your trend, which is our best friend, right? The trend is your friend, right? This is where the biggest money are being made, right? Trading with the trend allows you the highest chances of success. So this following my friend method, all right? Following my friend method, it boosts your chance of profiting from its continuation because you follow the trend, right? You will ride the momentum and then you exit it before the resistance or opposing pressure hits, right? So what? By entering where? entering at support levels during pullbacks. All right, so this strategy reduces the risk and maximizes the potential, right, for all these successful trades in a trending market. Okay, so how are we going to do this? What we're going to do is to use the 50 moving average. All right, so now in an uptrend, when the price remains above the 50 period moving average, it indicates that the market is what? Is experiencing a sustained upwards movement when it's above the 50 moving average. So as traders, we should what? We should focus on buying or selling. Buying opportunities, because the market is telling us that it's in an uptrend. It is sustained. This upwards movement is sustained. So now, trend is your friend, right? To capitalize on the trend, what are we going to do? We don't just want to enter randomly at the top, right? Because otherwise we'll be entering right smack at the highs, right? We want to what? We want to wait for pullbacks, right? We want to wait for pullbacks to the 50 period moving average. Or, I mean, it's not only one method, right? Or key support levels, right? So these are ideal entry points to buy, right, before the trend resumes upwards. So the key is to wait for price to show signs that it is bouncing off the moving average or support levels. So signs of this kind of bounce, right? Bounce, right? Would include what? Bullish candlestick patterns. For example, like a what? Like a hammer, like a bullish engulfing bars, right? So this confirms that what? Buyers are stepping in and the trend is likely to resume. So once you see this kind of confirmation, it is a signal to enter the trade that aligns with the strength of the uptrend. So this strategy, following my friend, helps you to capitalize on the trend by entering after the pullback, right? And then exiting before a major reversal. So aligning your trade with the trend increases your likelihood of capturing these kind of big moves. And that's where you also reduce the risk of counter trend trades, right? So now, in a healthy uptrend, price often just bounces off the 50 MA, right? Which is as seen here, right? By the blue line. So to trade this effectively, wait for, number one, wait for a pullback. That's where you're going to allow price to go back to the 50 EMA or a support level, right? A support area, right? Number two, look for reversal patterns. So at all this support area, right? The 50 EMA or support area, you want to watch for bullish reversal patterns, which is what we talk about, the hammer or bullish engulfing patterns, right? Number three, confirm your entry. So in this example, a bullish engulfing pattern indicates a potential buying opportunity at the right level. So therefore, the following my friend's strategy is where you enter a buy trade, right? When this pattern confirms a bounce from the 50 EMA, right? Signaling a continuation of the uptrend. All right, so now in this scenario, the entry point, this is where after observing that price is approaching and bouncing off the 50 EMA, you enter a long position when price shows bullish signals, right? Such as closing near the highs. Number two, stop loss. Set your stop loss where? Below the recent lows, right? So you got to provide some buffer to avoid being stopped out, let's say prematurely, all right, or by minor fluctuations, all right? Number three, your TP, right? Your target. So you go on to what? Aim to capture the next swing up. So typically, you can target the nearest resistance level or, right, another key point where the next opposing pressure might emerge. Because sometimes the trend can go even higher than the previous swing high itself. So that's where you're going to see where is the next opposing pressure after it breaks above the previous swing high. All right. So now this following my friend method would leverage this trend continuation. And that's where you use the 50 EMA as a dynamic support level that kind of moves along the way together with the average of the trend itself. All right. So get it? So this is where you exit your trade, right? Just before, in this case, before the swing high. All right. So now we emphasize the importance of exiting your trade before what? The opposing pressure comes in, right? So this trading with my friend, right? The following my friend method aligns with the idea of capturing the swing in the direction of our trend, our best friend, right? So now the final strategy that I wanted to share with you is it's more aggressive, right? But if executed correctly, it will give you a really good risk to reward ratio. Okay, so this strategy, it is designed for those who are more comfortable, right, with taking a little bit more risk for potentially bigger rewards. Okay, you ready? Method number 3 is what I call the hero. Okay, as you can hear from the name itself, it's going to be a hero. So this means that you are what? You are trading against the current trend. All right. So like a hero, like a hero, right? When the market has been trending strongly towards a swing high or resistance level, it creates an opportunity for you to be a hero. It's like, you're not going up anymore. You're going to go down, right? So that's what the hero concept comes in. So essentially, what happens is that you are anticipating that price will face selling pressure at the resistance itself, right? After the uptrend, right? Price is going to face selling pressure at the resistance. So that could lead to what? A temporary reversal or pullback. So, or even maybe a major downward movement, a reversal, right? So now, this hero strategy is you kind of going to bet that the momentum of this uptrend will slow down and price will move in the opposite trend. Okay, so now you may say like, hey, Ezekiel, like, don't you always say, and aren't we always supposed to think that, hey, we should trade with the trend itself, right? Right? I mean, yes, you're right. And that is the, what? Following my friend method, right? So, but trading with the trend, it's generally the best approach, right? But this strategy, right, is for those who wants to take a little bit more risk and go against the trend, right? And that's where you look to profit when the market pulls back or reversals temporarily, right? So this is what counter trend trading, trading against the trend, counter trend trading, right? It is riskier because you're going against the market direction, right? The price can quickly shift, reverse down, right? And quickly shift back to the trend itself. So you got to what? Manage your risk carefully in this method itself. You got to use stop losses. You got to stay alert in a way to protect your trades from sudden reversals that goes back in towards the main trend, right? I hope that I highlighted the risk towards this, right? Because right now you are trading against the trend. However, it can be, right? If you think about it, trading with the trend is one way. Trading against the trend is another way. This is like adding extra firepower, right? Extra sets of trades to your trading system. Get it? Right? Obviously, you got to master one first before going to the other. Right? So now, in this example, right, the market is what? It's in a strong uptrend, right? With price retesting the swing highs, right? Or the resistance area, right? So now, a counter trend trade, right, may be possible if price shows rejection signs like bearish candlestick patterns or weakening momentum itself, right? So a bearish engulfing pattern forms after this strong move up. So this signals potential increased selling pressure, right? And a potential trend reversal downwards. So the traders before who went long doing the breakout, they expected price to rise. But then a sharp reversal, right, created this what we call a bull trap, right? So that's where they are exposed to losses. So traders will what? They often place stop losses. They place their stop loss below the recent swing low, right? So this is where it creates a key area where a lot of stop orders they accumulate at that area. So if price reach this level, triggering these stops can intensify the downward movement and increase and accelerate this reversal downwards. So this is where once all these stop loss start getting hit, right? The selling pressure starts coming in, right? This is where you're going to see a big reversal downwards, and that's how the market moves, right? That's how the market moves. So this would trigger a domino effect, right? Where the stop loss drive the market lower, right? Amplifying, increasing this reversal movement, because more and more selling pressure comes in. The buy orders start closing at the area, right? More and more selling pressure comes in, right? So this what increases and signals the potential downwards movement, right? The downwards momentum increases as well for us as hero traders, right? Counter trend traders, right? So, but it is important to note that you got to have very strong risk management when you're trading against the trend, because like I said, right, a sharp reversal may happen, right? So now, as the price drops, it triggers stop loss from all these breakout traders, right? Increasing the selling pressure and lowering the prices as price goes down, right? So this is the logic, right? This is the logic behind the trade, right? And this is how we are going to take advantage of the increased selling momentum caused by all these stop loss triggers. Okay, so when you observe a false break where the price briefly moves above the resistance level, which happens, false breaks happens a lot. All right, this is how the real market works. So false break above, but quickly reversals. You can take this as a signal to go short. Okay, so the ideal entry point is the next candle open, right? After you confirm this false break itself. Okay, this will allow you to capitalize on this downwards momentum that is likely to follow as all these trap traders, they exit their position, right? Their buy positions earlier, right? So setting a stop loss obviously is important, right? Like I mentioned, right? To manage your risk. So that's where you're going to place your stop loss just above the swing high, right? Or the resistance level, right? To give you the room, right? For the market to move, right? And that's where you're going to protect yourself, right? You're going to protect yourself from maybe another false break, right? Protecting all these reversals, right? So this approach would capitalize on false breakout, right? While giving you a good risk to reward ratio, because you're entering at the top, right? For potential big move downwards. All right, get it? So now you can set it at a distance away from this high in anticipation that you can capture one swing down, right? Back towards this swing low over here. All right. So in this counter trend trade, it is important to be more cautious, right? To be more careful than with the trend following trades, right? Obviously, right? So here's the note, right? Key notes. You got to avoid holding this kind of position for a long period of time, because the higher time frame, they're all in an uptrend. This reversal may or may not be a big thing. Usually, they are just retracements. So you got to avoid holding all these positions in a long time. But that doesn't mean you cannot enter the trade and profit. You can still enter trade and make good risk to reward ratios from this kind of reversal trade, right? But just note that you are trading against the main trend. You got to avoid and be highly alert that you cannot hold the trade usually for a long period of time. So it's recommended to exit the trade if the price breaks and closes what? Above the previous candle high when you're shorting the market, right? Because this indicates a potential reversal back upwards, back towards the main trend itself. So therefore, you got to what? If you want to take a step further, right? You can trail with a tighter trailing stop loss, right? Just to protect yourself even more as another option. All right. So this approach, which is known as the hero, right? This approach allows you to minimize losses once the market turns against you and resumes to the big trend. Cool. All right. Now let's do a super quick recap. So let's sum it up, the three methods, right? Number one, box trading. So this involves trading within a range, right? By buying at a low and selling at a high, and selling a high and exiting at the low itself, right? So second method, following my friend. This captures swing in the trending market because the trend is your friend, and this is one of the best strategies out there, right? Number three, the hero method. This is a counter trend strategy, right? The counter trend strategy where you trade against the trend, right? After the market breaks out, right? And it hits towards a key resistance or key levels and then face rejection from there. So there you go, right? There you go. Swing trading and using this three method is essentially how the market works. Whether they're trading in the consolidation, whether they're trending, whether they're reversing, this is where we got it all covered itself. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.